Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking GQG Partners, ASX code, GQG of course. G'day, Elio.
Yeah, g'day, Phil. I thought it was rather interesting to bring this stock up now, given that it's had a tear for the last, say, 12 months or so. But I think in the last 3 months, it's sort of tracked sideways, and there may very well be some investors wondering, what do I do now? So I think it's a good time to bring this stock up.
Okay, so tell us the GQG story. It's a financial services company, I believe.
Yeah, that's correct, Phil. There's not really much to talk about other than you give them your money and they manage it. And really, that's what they've done. And they've got, I think it's about 14 funds that are located here in Australia, as well as overseas and international focused funds. In fact, I think they've just launched their private capital funds as well, too. So they're basically looking to take that off market and service that environment as well, which you would expect that to be a big boon for them moving forward. But I mean, let's face it, this is a company that's been doing quite well. They've been managing money quite effectively. In fact, I think nearly all, if not all their funds are basically 5-rated or 5-star rated, I should say, according to Morningstar. They've got incredibly good ratings. Their outperformance on a 1-year, 3-year, 5-year, and since inception has been exceptional, outperforming their benchmarks relative-wise, and therefore you've seen strong inflows into the business, which the company announces on a quarterly basis. So it's quite easy to see the flow of funds into the company, which have been quite strong. So, yeah, traditionally I don't invest in these types of businesses, Phil, because really they're doing what I'm trying to do every day as a DIY investor. But nonetheless, though, you can't ignore the strong metrics that it does produce. And in particular, I wanted to bring it to everyone's attention because on a Stockopedia basis, we actually rate companies that are capital light quite heavily. And let's face it, when it comes to managing money, all you need is a PC, a couple airline tickets, and a bloke at the other end, or lady at the other end of a computer screen somewhere doing some typing. And that's pretty much it. So because of that, that's actually quite attractive to us, and hence why it's had quite a high stock rank for quite a while and was actually included in our no admin portfolio system, our NAPS portfolio, as it were, which is basically you pick the highest ranking stocks in every sector at the start of the year and then you do nothing. So it's the total approach of apathy, and this is one of our better performers in regards to GQG because, as I've mentioned, their share price has gone on a tear for the last 12 months, although that has changed recently.
And they're based in Florida. Is there going to be any effect on the numbers due to Hurricane Milton coming through?
No, assuming that you'll be able to get an internet connection in a building somewhere else across that wondrous land, of course. I don't envisage there being a major impact, but it does raise the question, why did they come to the ASX? And look, far be it for me to say as to why necessarily they did that, whether it be longings or calling home or access to capital or any of that sort of thing. But notwithstanding that, when you're talking these sorts of businesses, and let's not forget, they rose from the ashes of what was Magellan, and we all know about them, and there was a key focus or key person risk in regards to that, and then they left the company, and then the company's floundered ever since, and investors were really looking for another option, as it were, to park their global investment money, their active, in particular, global investment money, to which GQG came along. So it was sort of a real sweet spot for the business when they hit our horse, as it were, and they've been able to capitalize quite successfully for investors if you've been able to get a bit of a parcel in them. I'm sure we'll talk about how tightly they're held in a moment. But I mean, in regards to this company, I don't expect any of the real world concerns to be an issue because ultimately they're investors, just like you and me, Phil. And ultimately they will take the clip of the ticket in regards to the performance that they're able to achieve for their investors.
So speaking of the clip of the ticket, are the numbers all about the funds under management? I mean, we see that acronym all the time, FUM, but that means funds under management. So is that the key metric for GQG?
Yeah, it's actually the primary driver, to be quite frank, which makes it in a really unique situation where we can assess on a regular ongoing basis how things are going, because the company releases it monthly in regards to whether they've seen net inflows. In the case of GQG, you've seen that, or net outflows, which is like a Magellan, for example, or whatever they've renamed themselves now at the moment. So obviously, if you're seeing funds coming into the business, that's a really good sign, because they take that clip of the ticket, which ultimately means that the more money that they manage, the more that they can generate. And we're talking about a dividend yield of over 8%. So they pay a lot of it out to investors. So this is a traditional income type of stock, whereby they are focused on a myriad of different types of investments, and they are paying out a bucket load to investors, which, to be fair, when it comes to the fact that there is that key man risk, a chap by the name of Rajiv Jain, in regards to his interest, which beneficial interest, which is around 70%, he obviously gets a pretty decent dividend check every year. But us as beneficiaries, in regards to being investors in the company, we also get to see that as well. And to be frank, the growth that they've seen, which now sees them managing over 161 or 60 odd billion funds under management, I mean, who can fault them? And that keeps growing on a regular and consistent basis, as we saw in the recent monthly update in regards to net inflows into the business. So, look, this has done quite well. Its share price had gone on a tear, as a lot of people were sort of looking around in the aftermath of previous high-profile managers that went underwater, or started achieving disappointing returns. And then here was a beacon, a light, as it were, where you saw outperformance in regards to all their funds. And that probably is the second element of returns, or performance, as it were. So one is net inflows, and then two, look at performance, because that's what obviously keeps people there, or at least keeps the advisors happy to keep their people there and not do anything and take their clip of the ticket. Feels like a bit of a gravy train if I say it out loud. But nonetheless, that is where they're doing exceptionally well. So net inflows, good performance, and bang, they've achieved a wonderful return. But then again, everyone's now saying, right, you've done well in the past. Where are you going to go into the future? And everyone's sort of looking around, wondering to themselves, where to now for GQG? But to be frank, the numbers are still quite good, and therefore investors ignore them at their own peril.
So these are kind of funds, I'm assuming, that when you look at, say, someone's pension account, that it's going to be invested in all sorts of funds. The financial advisor is going to place their clients' monies in funds like this. Is that the case? And how much of their business is marketing? And how do you market in this kind of area?
That's a very grey area, because it makes it incredibly difficult to do in our current legislative climate. So GQG can't pay advisors, as it were, to just push their product, because there is a fit for purpose sort of rule that advisors have to follow. You're right that there are a wide range of category of product offerings, global, local, international equities outside of that now. And that is obviously a big driver to the net inflows into the business. When it comes to marketing, you can't do much other than performance. So your performance, your track record, the trust that you build with the advisor is obviously key and critical. Now, let's face it, it's not going to be you or me that are driving the net inflows that we've seen in this business and see it now managing some $160 billion. So it's not quite focused on us. But then when you do that on a cumulative basis across the wide board, and you build that trust, and you deliver on, what it is that you're expected to do, you find that money tends to be pretty sticky. It doesn't go anywhere else. So the marketing is pretty much, walk the talk, as it were. If you say you're going to outperform and you do outperform, then that is exactly what advisors are looking for. And if they do that, then they're happy to recommend these vehicles to their clients, to which then once the money comes in, it generally stays in, and you get this wonderful hockey stick sort of approach. And we saw that in the latest half-year result. I think, Phil, if we saw margins are still doing quite well, which means that if you're getting more revenue in the door, that hockey stick approach of your net profit rising also occurs, which is what investors have been so excited about. And the fact that they're still able to maintain very strong levels of cash flow into the business, irrespective of the fact that they're paying a forecast dividend yield of around 8.4%, that is obviously a big tick on their management and a big tick on their process, and hence why many income investors probably would have discovered GQG Partners some time back.
Yeah, I like pulling back the curtains on what happens behind the scenes in this situation. And I'm assuming that dealer groups and advice shops They have things called approved product lists, don't they? So I'm assuming the key to any business like this would be to get on as many approved product lists as possible.
That's correct. Exactly right. So once they're on that APL, because we love acronyms in our space, then that ultimately opens them up to the advisor, because then they can't be sued if they recommend one of those items. So obviously, it's cognizant on the business to do quite well to get the rating. So they've got to pay for that generally. And, you go out and there's the Morningstar, of course, and there's all the Van Eycks and, various Lonsec reports and the various others. And all those funds from GQG are actually rated quite well. So they are on APLs across the board and therefore do make their way as part of that. So notwithstanding that there is a fee, because all the young rocket scientists that are analysing such funds and their approach and methodologies, et cetera, and reading over that, they need to eat as well. So therefore, there's a payment that has to go there in regards to that. But if you rank quite highly, then that opens you up to just being recommended. You then have to build the trust with the advisor and your distribution network, and that is done through a whole range of BDMs, or business development managers, as they call them, who go out and press the flesh, as it were, and build on that relationship. And then ultimately, it's up to the investment team to deliver on what it is that's being said. And when you get all of that moving quite smoothly, as you have in the case of GQG, then what you're going to get is this net inflow boost, which has definitely occurred, which there can be a bit of a lag behind that, in between the company getting a bad rating and then a slowdown in the net inflows into the business. But, that's definitely not the case with the GQG partners. Not at the moment anyway, but you can never say never in this game, of course.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. Okay, so third-party distribution costs. The share price has fluctuated this year due to cost increases. What are these costs? And I'll just refer to something from the news page on Stockopedia that says the half year saw higher compensation, general and administrative, and third-party distribution costs. Tell us about these costs and how much it affected the bottom line. Because this is a low capital business.
Yeah, that's right. It's a great way to sort of cover it all up, isn't it? Well, for any successful business out there, there's always someone trying to take a bit more of the pie. And that is no different in our sector than it is anyone else's. But obviously, the more you're rated, the more it costs you. The better your performance, the more you got to pay the rocket scientists that are doing the stock picking. The more that you're selling, the more you got to pay the distribution team in order to go out there and sell. So it's almost a function of its success, as it were, that as they go about achieving more that they're achieving, and notwithstanding that there's not that much that changes in regards to their operations. In fact, the late Frank Costa, a legend here in Victoria, of course, I can still remember him quite distinctly saying to me, and to a group actually that was listening to him, that the cheapest thing in the world to buy is brains. And when it comes to a company like GQG, that rings true. But that means that you've got to pay the ferryman once you achieve success. And they've had to do that consistently. And hence why you've seen a rise in costs across the board. So it's nothing sinister, nothing to necessarily be all that concerned about. But it is obviously just a matter of fact in our space that the better you do and the bigger you get, the more you're going to have to pay. And that's just a fact of life. It doesn't quite work like the expanding tram tracks like a lot of people might hope it might do in our space. Quite frankly, if you make more money, then you pay more money. It's as simple as that.
So run us through the financials, Elio.
Yeah. Look, in terms of Stockopedia, this is a company that rates a total stock rank of 95. Now, it's important to note that this has actually come down a little bit from where it was at the start of the year. But then, to be frank, when you're looking at a ranking system that goes from 1 to 100 and you're already close to that 100 mark, then to be quite honest, if you're a scientist at heart, you will know that the larger propensity is to go down rather than it is to go much higher, because there's no more tree to climb, as it were. And the biggest drag on that overall stock rank score, as you would expect, is value. Value is at 66 at the moment. And look, let's face it is a bit of an inverse relationship between value and share price, because the share price has done quite well. I mean, it's outperformed the All Ordinaries over the last year by some 60-odd%, which is quite good. But obviously that doesn't do great for its value. But then again, if you look at its PE ratio, I think it's sitting around 11 at the moment, then that's including all the forecast growth that's baked into the share price, one would assume. Then it's actually probably not lofty at these levels. And it's probably better buying now than it is back towards the end of July or close to August. So at least that's a bit of a win if you haven't had it or taken an exposure in them yet. But as I mentioned, the first few months of the year, in particular, the first 6, they went on an absolute real tear in terms of share price performance. And much of the outperformance was captured in that period as investors really discovered GQG and therefore got onto the back of it at that stage. But now it's somewhat tapered off in recent times. I did allude to the fact that the quality of a company like this rates quite highly because it's capital light. I mean, we're talking about a return on capital of 85%, return on equity of 92%. We're talking some pretty strong operating margins, which notwithstanding the price increases still sit around the 75% mark. The reason why we did see or did experience a slight decline in the quality rank compared to where it was at the start of the year is pretty much in regards to, just some basic, how shall I put it, accounting sort of issues that are sitting in regards to the actual balance sheet itself. But the growth that it's been able to achieve and its valuation metrics, as it were, still put it in a quite an attractive light. And then we're talking about momentum, which I suppose if we can talk, pre the all-time peak and then post the all-time peak. I mean, pre the all-time peak, the thing just went on a tear, and we were very fortunate to catch much of that outperformance as the share price continued to run up quite strongly. But over the last few months, the share price has tracked sideways. And that has led many to wonder, has the good times ended? And if you sort of squint, you'll probably see a channel starting to emerge on that right-hand side there of the chart, which traditionally is not a good time for momentum investors because you get a flip of the coin. Could it go up or could it go down? It's sort of trying to create new lower lows and new lower highs. It's just sort of doing nothing but treading water, which means you can get a lot of whipsawing action. But its price has now fallen below its 50-day moving average at the time of this recording. It's still above the 200-day moving average, so that's still a positive. And I mean, on a yearly basis, it has done some pretty solid outperformance, as I mentioned, notwithstanding that over a 1-month and 3-month basis, it's probably not as good as some of the other peers that have been out there. But how Magellan blew up and Pinnacle doing well and Perpetual struggling and everything in between, all of those may very well be something that you're kept abreast of and that you are aware of, given that you'll be looking at net inflows. I mean, if they still remain strong, you're good. If the rankings for the business still remain solid and they remain good, then you know that money has to go somewhere. And GQG at the moment is putting itself in the right place in order to take that. So this is one where, the fundamentals actually look quite good. I mean, to be honest with you, if you look at that 12-month basis and how it's done, momentum is the highest ranking component of that overall 95 stock rank, which is pretty good. Value is a bit down, but I mentioned that inverse relationship. And the story is actually quite good as well. So tick on the financials, tick on the story, and therefore tick overall. So it sounds pretty good at the moment.
I'm constantly surprised talking with you and Chris we hear about companies that are on, this is quite solidly in the ASX 200. And, once you've gone past the banks and the miners and the retailers and all the big names that we all know as household names, that we come up with companies like this, which are totally off the radar if you're just looking around for companies that you already know about. So it's nice to hear about these.
Yeah, no, definitely. I mean, that Rajiv Jain interest of 70% in the business is something investors have to be cognizant about. I mean, look, if he sold down a few shekels in regards to or to help improve liquidity, may very well boost a bit of confidence and have some of the more larger funds on the outside world look into the business. But, when you're paying an 8% dividend yield like this on a regular basis and your share price has gone up so strongly over the last year and a bit more, then why would you actually sell any stock that you hold? But we can't really equate that if they do make or if he does make liquidity. And he's the CIO, folks, if you don't know, so the chairman and the chief investment officer. So he's obviously got a vested interest and strong control over where the funds and where the business goes in terms of its direction and how the funds perform, et cetera, et cetera. And yes, of course, we know that the big banks, they already, again, occupy the top of the tree in regards to market cap. We know that there's a Macquarie out there, which basically trade in everything except potatoes. I don't know if there's a market for that, but it comes out of the ground, they're into it, and everything else in between. So, obviously stocks like GQG do fly under the radar of many investors. Not too many, though, because like I said, they've had a stellar 12 months, and not of advisors who do live and die by that approved product list, as you mentioned earlier, and the performance that the funds have been able to achieve, and then up to them to build that trust, et cetera, in order to then create that sticky money where you see that hockey stick sort of approach. So, look, the private capital new funds announced that the half-year result will probably see a further increase in net inflows into the business, assuming they can perform just as well. If they do that, and the fact that its valuation isn't too stressed, notwithstanding the valuation or the value score decline, we think there could be a bit of a further opportunity in regards to GQG. And yes, when you're looking around for a stock to replace, that once high-flying Magellan, as it were, and I hate coming back to that, but that was such a spectacular collapse, as it were, or how shall we not collapse? That's the wrong word. It's
a great lesson for investors, let's call it.
Yeah, let's just call it a great lesson for investors, because it was quite obvious what was happening. It was like a slow-moving Titanic.
There's a rock star in control, and watch out for the rock star-led companies.
Yeah, I mean, a cynic might say once you see them on the front page of the AFR, that's probably the time to get out. But I'm not going to go so far as to suggest that. But obviously, when there is a key person, you do need to monitor what they do. And in particular, whether there's anything that marries up to the story or not. And let's face it, some companies like a Pro Medicus that we've talked about on this program before, which has continued to go up. Well, there's a standard sell down process which has been occurring for quite some time. And I can tell you now, they're not selling down because the business is bad. It keeps doing really good things, including a new contract extension there with Mercy Health in the US. So these things aren't necessarily what you want to worry about or concern yourself about, but it is something to keep aware of. If you see net inflows go down, or so they become net outflows, you start seeing poorer performance, and then you see a key person, start to either lose their marbles or, effectively start to sell out of their interest, then that is something that you do need to be aware of. So we've had previous experience on this on the ASX before, and I'm just saying that actors might change, but the plot remains the same when it comes to investing. So just keep in mind of that when looking at GQG Partners.
Just quickly before we wrap up, you mentioned the dividend. Because of the overseas source of revenue, does that mean there's not much in the way of franking credits?
Yeah, that's correct. There isn't much in the way of franking credits. And then to be fair, look, I know people that have lost their life savings trying to chase a tax deduction. But you know what? I'd rather pay tax on capital gains than to accrue capital losses. And I won't let you think too much about that, Phil, in regards to what that means. But you have to appreciate and understand that where GQG has come from relative to where they are now, the fact that, they were that capital-light business, they were paying a smaller dollar amount dividend early on. That is now much larger than what it was before. But even at today's prices, the dividend yield itself is actually still quite attractive. So notwithstanding that it does cost you a little bit more in tax, from my perspective, I'm quite happy with that.
Elio D'Amato, thanks very much for joining me today.
Thank you, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.